What is going on, DeRosa Insiders community? This is Matt Faircloth, and welcome to DeRosa Insiders live program. This program is live. That's why the name live is in there. This is live on our DeRosa YouTube page. So go to YouTube, look up DeRosa Group. You'll find it. It's right there. Also go to Facebook, look up DeRosa Insiders. You'll find it there as well. You also go to our DeRosa Group page on LinkedIn. You'll find it live there as well. And even the company page on Facebook as well. Appropriately named DeRosa Group on Facebook. You guys can find this program streaming there as well. So wherever you're watching, thank you. And if you're watching the recording of this program on Spotify, thank you as well. If you guys like what we do, please like this stream and like this program in whatever social media platform you are watching, or leave it a 5-star review on Spotify. That would be super, super grateful. We'd be grateful for you guys doing that for us. I got a great program coming out for you guys. Got a great guest and something that I think is misunderstood in the real estate investment industry. Like, think about this. What is the most misunderstood thing about real estate investing? Well, I'm not going to tell you. You got to listen, and if you want to understand something that's misunderstood, that's your hint. Stick around for our guest today, who's going to talk to us all about that. I'm going to be jumping into a current event now, so stay tuned. Post your questions for anything happening in the real estate market. Would love to talk current events with you guys in the future. So if anything's happening now in the real estate investing market, aside from today's election day, no need to talk about that till after we find out what happens. Then we'll discuss here on this program what to do to plan for whoever just got elected president, or what the new administrations are going to do. Not worth talking about today. Let's talk about it then. All right. So now let's jump into our current event. Guys, I want to talk to you guys about housing prices and the housing market, right? Because what you guys might be looking at is, well, Matt, interest rates have gone up, and in essence, they've doubled in some markets, and in some, depending on the type of mortgages you're getting, right? And so you might look at this and say, well, if rates have doubled, then housing supply and the velocity of housing being sold should be in one half, should it not? Right? It should be directly correlated. Yes and no. Right. What's interesting is that housing absorption is at or around what it was pre-interest rate spike. Right now, there's been some decline. Some folks in this article that you guys can grab are showing there's been in some markets a 5 to 10% decline in absorption, but that is nowhere near the interest rate increase that we've had. Why? Let's go there for a second. Okay. There is an enormous housing shortage in America. A lot of people, first of all, so we don't have enough housing. So a lot of people are still looking for housing, and they're going to pay what they can pay for a house, whether they like it or not, even with rates being higher. That's number one. Number two, with rates being higher, less people are selling. If you are out there with a 3% mortgage on your single family home, you might not be selling. You might decide to, as the retirees, as my own mother likes to say, age in place. You might say, you know what? I got myself a 2.5%, 3.5% mortgage. Why would I sell this and go upgrade or downgrade to other housing that's going to cost me 6.5%, 7%, right? So less houses are for sale. So supply has gone drastically down in America in housing, while demand is still there. People are still need places to move. There are millennials that are creating families that are looking to expand and buy their own home, right? There are new folks moving to the country that need places to live, that want to buy a house as well. And there are just people looking for housing for one reason or another. The demand has not changed, right? But supply has gone down, and that's caused the need for housing to be still high as compared to what it was even when rates were much lower. So the thought process that rates drive housing sales is partly true. It's partly true, but still, you've got supply on one side, demand on the other. Picture like an X like this, with supply being one, demand being the other. Interest rate is one of the factors that drives supply and demand, but it is certainly not all of it. There's other things, like just a supply shortage of housing, and also I'll give you one more statistic fact. A lot of new delivered housing is being built now, but the amount of permits that builders and developers have pulled for new stuff they're going to be building and that will be delivered in the next 6 months to a year is at an all-time low. So that means there's not going to be much housing built in the United States over the next year or two. What that means is that regardless of what happens with interest rates, demand for housing is still going to be really, really high. And so will there be more supply? I don't know. Maybe if rates go down, people will decide that, okay, now it's a good time to sell my home and move. That will create an increase in supply, perhaps start absorbing some of the demand that's out there. But it's not going to happen through builders because a lot of builders have built out. They're selling what they built now, and they're going to take a pause. They're not pulling permits for new stuff that they're going to build. So there we go. So my bottom line prediction for housing, guys, is we're going to see continued demand, continued high velocity of housing. If you are a real estate investor, as we are, and as you guys may be as well watching this program, I firmly believe that getting into the housing creation space, fix and flips, new construction, if you got the chops, the knowledge, and the capital to do it, new construction is a great place to be. It sounds counterintuitive given how high rates are, but guess what? Things don't change, or things do change. Rates will be going down at some point, and the demand is still going to be there. And so I believe that creation of housing for people to either lease or buy is a great space to be in, whether it's new build or fix and flips. That's my tip for the day and my prediction of the current market status. Nabiku, please drop that article that we're referencing here for our listeners and our watchers, for you guys to check out the article. It's a good one here on AOL Finance. You guys might want to check out for more ideas, more inspiration. That's what I got for today's state of the market tip, guys. Take care. All right, guys, state of the market is done. Things happening in the real estate market today. Conversation is done. Now I want to bring you guys into a conversation about let's say, a misunderstood something in the real estate industry. And it's something that, as I've come to understand it, I've learned how to be more respectful and present to this thing, which is insurance, right? And some of y'all might think, hey, necessary evil, it's there. You got to just pay insurance with your eyes closed. Just pay whatever insurance broker says you got to pay, without having any say on it, and without being able to be in the conversation with your insurance broker. Well, if that's the case, if you're just like writing a check for whatever they tell you got to pay, you get the wrong insurance broker. And we want to introduce you guys today to the insurance broker that covers the DeRosa group, right? What better way for you guys to grow and learn from somebody that we use, that one of our vendors, that helps us learn and grow ourselves as a company. So I want to bring in the insurance broker for the DeRosa group that does all of our stuff, my buddy Bo Shaw. Bo, how are you today, man?
Hey, Matt, it's good to hear you, and happy to be here.
Good stuff. Good to have you here today, man. Could you we call you guys IOA, but the real name for your company is Insurance Office of America, right? And that, could you tell us and your list and our listeners a little bit about you, and then we'll hop in to help our listeners understand the world of insurance a little bit better. That's my goal today, to help them understand. But Bo, tell us a little bit about you, and we can hop into the combo.
Yeah, I'm with Insurance Office of America. I started here in 2016. Based out of Atlanta, Georgia. I specialize in real estate, part of our commercial real estate pod. We're a national firm, 20th in the country for independent agencies. And we work as niche producers, specializing on a specific class of business. And we have niche producers all over the country. So we're able to cover a wide range of the country and be experts in the space. And it's a great firm, and I appreciate you having me here today.
Absolutely. And I want to say that that it has been great working with your firm as well. We're not going to just have this love fest the whole time. What I appreciate about having an insurance agent, and this is to really the DeRosa Insiders listeners as well, is that you guys want to have someone who's willing to teach you. And Bo has been very willing to teach me and our team, not just about why it's a great idea to just pay him whatever he says we should pay for insurance for our properties, but what we can do to avoid claims, what we can do to just keep our insurance costs down. For example, not to let the cat out of the bag 100%, Bo, but I was at one of our properties in North Carolina several weeks ago. The residence is at Diamond Ridge, which you guys insure. And our regional manager was there, just going off on the site manager about how they had driven to the property and they had seen, Bo, believe it or not, a barbecue grill sitting on the tenant's balcony. How dare they? right? And the regional manager had been educated by probably one of the higher ups in my team that had been educated by you about how that is a 100% risk factor, right? What are some other things that, I mean, and obviously by us alleviating those barbecue grills on those balconies and causing the tenant to say, hey, listen, that thing needs to be 10 feet away from the building or more. I get it. Put it somewhere else. And we also provide public grilling areas that tenants are more than welcome to use. A lot of our tenants now take their barbecue grill off of their balcony and put it in the public grilling area for them to use as a community there, right? It kind of becomes a community barbecue. Let's all own it together, right? Versus having it privately on my balcony, right? Anyway, could you talk us through some things like that are easy, low-hanging fruit lessons that you've educated your clients on over the years?
Yeah. So, I mean, you got to think about it. A lot of these older vintage apartments are, framed buildings, non-sprinklered, and they're very combustible. So,
yep.
When they do catch fire, they ignite and they spread very quickly. So, you rarely see a single tenant or single tenant apartment fire. It's usually going to spread. Hopefully it's contained to one unit, but over the 8 years of doing this, I typically see multi-unit damages. So one way that, grills are a great example. If you have hot coals and it catches the building on fire, it's probably going to spread quickly. Other things are, making sure that you have fire extinguishers if it's a non-sprinklered building. Are those easily accessible to the tenant so that when they do have a kitchen cooking fire, rather than panic and run out the door and let the fire continue to spread, they may be able to put it out and limit the amount of damage. Smoke detectors are great to alert tenants to get out of the building from a life safety perspective, as well as maybe being able to put the fire out quickly. Other things are like deferred maintenance, furnaces that may not be, or they're reaching their max potential life, and you've got a hot summer and it stops working. Well, your unit becomes hot. The tenant may notify you, but by the time you can get your preferred vendor out there to correct it, the tenant could be, trying to just put it down to 50 degrees, even though it's not working, and it's still running, and eventually it catches fire. And the next thing you've got a large fire. So it's just, a lot of it comes down to, having the right risk management procedures in place, as well as taking care of the deferred maintenance issues that may give you a higher risk of having this claim, because once it starts, it usually is a very catastrophic event that can impact the life of others, your insurance program, and just being able to implement that into my clients' procedures, which you all have done a great job at, is something that we take a lot of pride in.
Yeah. I mean, I think just the idea of having a procedure, like having a program, and we'll talk about a few other ideas a bit, like suggestions and whatnot you've given us as we get further into the interview here. But like, first thing first is insurance should be a proactive space. That there are things that through implementation plans and ways to make your property safer, and that you're going to maybe lower premiums, or at least avoid potential catastrophic things. Because as much as that's why there is insurance to pay out when awful things happen, I'd rather not ever have a claim, because the pain in the butt you got to go through to have a claim is just typically not worth it, right? So backing up. Insurance has gone up quite a bit over the last couple of years. There's been talk of those increases changing, or maybe not being as much. Give me like a state of the market and where things are right now. And we're talking, of course, today, mid-sized multifamily. I know that's major focus for us at DeRosa, major focus for your company as well too. Where are you seeing things compared? Give me like the last, what's happened in the last couple of years and what's happening now.
Yeah, so I'd say 2016 was about the peak of a soft market. And
Mm.
2018 is when we started seeing trends of a hard market. So those are kind of the two different spectrums of an insurance market. And so since 2018, we've been trending into a hard market, and we've seen it doesn't flip overnight to where you're going to see the peak of a hard market in 2018. So we were seeing signs of a hardening market. And since 2018, we had COVID. We saw the increased cost of construction. Social inflation is higher than ever, and we've also had, the last 5 years were probably the worst from a billion-dollar loss event that we've seen nationwide, with 2023 being the worst. So the market hasn't really improved since 2018, and it's actually gotten worse. So we are in about the end of the life cycle of a hard market. There's been a lot of adjustments from a carrier appetite underwriting perspective over this period of time. And now a lot of it has come to present day, and we're starting to see improvements in the insurance marketplace leading into 2025. A lot of reinsurance treaties renew in January of each year. So if you're looking at 2024, we're 11 months into the year. You're not going to see, the market deviate much from where it started at the beginning of the year. We have seen some improvement, but I think going into 2025, what we're hearing from the marketplace is that it is not going to continue to harden for the most part. And we may see reductions in premiums through 2025, which we did see in 2024, depending on where you were previously. But from a market rate perspective, across the board, we should see improvement.
Mm-hmm. A few questions. What's a hard market versus a soft market, right? Like this, and I just want to I think I understand what you're talking about, but for our listeners, I want to make sure that that we're getting a vocabulary lesson here, right? So, what's a hard market versus a soft market? Start at that one.
Yeah, so a hard market is when rates are higher, the insurance carriers want higher retentions. There is less carriers in the insurance marketplace to participate in offering terms, which is driving competition. So when you're in a hard market, you have, say, maybe on a multifamily deal, 10 to 15 carriers that are willing to offer terms. And in a soft market, you may have 40 insurance carriers willing to offer terms. So when the capacity shrinks, the carriers are able to basically set terms easier and make it harder for the consumer to buy the insurance, but they're basically setting the terms. We're in a soft market, there's competition, there's programs, there's opportunity for insurance carriers to get profitability.
Okay. And then these cycles, this common in the insurance industry, that your markets go from hard to soft, and like the expansion of new companies coming into the space. And then as the market gets a little bit harder, those companies either go out of business or get absorbed, or whatever. And then there's consolidation and less players, like you said, supply. I was saying earlier in a prior commentary, supply demand, right? So there's the less supply of options for a insured looking for coverage. So less people in, so it doesn't have to be as competitive, correct?
Correct. And it seems to me that it kind of follows the economy.
Okay. Now, used another term, social inflation. Is that the same as economic inflation with regards to, cost of goods going up and that kind of thing, or is that a different thing?
It is very similar, and it's tied to nuclear verdicts where personal injury attorneys, you have a premises liability suit. We're seeing the largest nuclear verdicts we've ever seen, as well as just the cost of living has gone up. So in these demands and in these suits, they're settling for higher than they've ever settled before.
Okay, because of the GL insurance claims and stuff like that, right?
Correct.
Not like buildings burning down or like, damage claims, general liability claims.
Yes, absolutely.
Huh.
So your insurance is going to fall under property insurance and liability insurance, and the social inflation is tied to the liability aspect.
Huh. Okay. And we're seeing more and more settlements come in for higher and higher numbers and that kind of thing. Are
Yeah.
you do insurance carriers predict that to go down? It seems like that's, when I drive on the highway, all I see is billboards for have you been injured? And everything like that, which
It's
is all,
tempting.
yeah, I know, right? I'm like, man, maybe I have been injured. I don't know, like just some of
Yeah.
these people, does that tend to ebb and flow, or is that just a tide that just continues to rise as more lawyers are out there, helping people find easy money through whatever workman's comp claims or, whatever it may be. I mean, I'm embarrassed to tell you all the different claims we've had for liability for people that show up for absolutely ridiculous stuff that is clear had nothing to do with anything, but they try and pin it on somebody, right? And they got a lawyer willing to try and run the case up to flagpole, right? Do you see these things diminishing, or do you think that's just, that rising tide is just there and we have to deal with it?
Yeah, so from a liability perspective, we are not seeing that market soften like we are the property insurance market.
Okay.
A lot of these liability claims, they have long tail lives. So you may have a claim in 2020 that's still open in litigation, or 2021. And so the carriers, when they're underwriting from an actuarial perspective, they have to hold these claims open for much longer. And it also requires tort reform within to protect the insurance carriers, which tort reform is going to take a lot longer to get passed, if passed at all. So
good luck with that, man.
Come again?
I say good luck with that. You're going to
Exactly.
have
Yeah.
lobby on
So
both sides. You certainly have insurance carriers that are lobbying for more realistic rules around things like that. But you've also got a ginormous amount of lawyers that have made a very good living for themselves. So it's chasing ambulances, so to speak, right? So there's a interesting battle there. I'm not sure who wins that one. I've heard both sides of that, and I don't have a dog in it. I'm just curious, Okay, so other things driving the cost of insurance. You watch the news, you hear of all these natural disasters, especially Florida just got pummeled this year with regards to hurricanes. Every time, I feel like every time I, looked at on my news feed, there's another hurricane going after Florida this year. What do things like like recurring natural disasters do for driving up the national insurance market? Like, is that going to does a hurricane hitting Florida, indirectly cause my premiums to go up for my property in Kentucky?
yeah, they do. But at the same time, it's not as drastic, because your property insurance carriers in Kentucky aren't really participating in coastal asset insurance programs. So they have a designated market that I look at most things from a cat perspective and a non-cat perspective. So but if you look at Hurricane Ian, for example, that was a $75 billion insurance event. In these last two hurricanes that came through, they were much smaller, maybe, don't hold me to this and the numbers aren't released yet, but
Just
10 to
have fun.
15 billion maybe. So these hurricanes this year really aren't going to move the insurance market as much as if it was a catastrophic event of Ian. And it's pretty much where it hit. While Tampa area is a high concentrated area, a lot of that was tied to flood insurance, and flood, for the most part, can be government program that's providing the flood insurance, so it's not impacting the insurance carriers as drastically. That's not the same for all scenarios. Sometimes the insurance carrier that is writing your property insurance is extending flood coverage, but most of them probably aren't giving away a ton of flood coverage on catastrophic areas that are going to be getting hit by hurricanes, which pushes it to the government programs. But yeah, so you are impacted. The whole country is impacted. They're all, participating. And that's what a lot of people ask all the time was, well, I didn't have an insurance claim. Why is my insurance going up 15%? But the carriers, while they're writing on an individual location perspective, they've also got to look at their books on what they're bringing in and how it's performing, and then set rates and standards to achieve the line that they're trying to accomplish.
Got it. Okay. Well, it's good that it's all good factors to consider, for folks like us trying to, understand, why things change. Right. Okay. Moving to another conversation here. Somebody that one of our listeners here or ourselves or whatever, we're looking at a new asset, let's say, right? And I'm underwriting the property. And I know we can certainly just call you and say, hey, Bo, we're looking at this 100-unit apartment building or this 30-unit or 10-unit, whatever it is. Can you get me a bid? Right. Certainly could do that. What are some other things that someone evaluating, because you might get tired of bid, we probably evaluate something like 30 to 40 deals a month, right? That's probably more than you'd be able to keep up with. So as someone underwriting a deal, what are some other things they should consider when looking at it? I've heard that we should not make a mistake. And I think this is a rookie mistake that I want all of our listeners, if I can give you guys one thing today, talking to you, listener, is looking at what the current owner is paying as a indicator of what you will be paying for insurance. I'm not saying it's completely unrelated, Bo, but I do think that could be a mistake. Do you agree? And what's another method they should use?
Yeah, I mean, my recommendation would be to, find someone similar to me that understands the insurance market, and they can, have them educate them on insurance and how they can build a model within their underwriting of their acquisitions team to take OMs and build out a model to project insurance costs. And it's not always going to be accurate. There's a lot of factors that I'll go into that can change that. But, based on the type of asset, the age, the construction, where it's located, and a couple other factors, you can model insurance costs with present day rates and get a pretty close estimate of what it's going to cost, and then compare that to the T12 or the OM to see how does that align. All right, is it lower? Is it higher? Well, why is the T12 higher? And ask the seller or your broker to get clarity on how their T12 insurance figure is being created. It could be that they, going back to 2022, 2023, a lot of people hadn't seen the large increases of sometimes 50% yet, because insurance runs on a 12-month term. So they may have renewed, got ready to list their property because they knew their insurance was going up 50% in hopes that, they could sell that property before they took a 50% insurance increase. And so just doing things like that, identifying, risk characteristics that are challenging in the market. So I'll kind of go on and tell you about some of those. Aluminum wiring is a very challenging placement. It is, common for properties maybe 1969 to 1975, but that's not a hard age of construction rule. Those are very difficult placements. They can be remediated, and everyone wants to say, well, it's remediated. Why are we still getting, facing issues with it? Well, it still has aluminum wiring. They just put a Band-Aid on it to remediate it so that it's safer. But the insurance carriers still have regulations and appetite and guidelines that they have to comply with through their company or their reinsurance that's backing them. And a lot of them have limitations on aluminum wiring because they want to reduce their overall exposure from, their portfolio business. Panels are another important one to look at when you're underwriting an asset. Does it have Federal Pacific stab lock panels? Those are prohibited by most insurance carriers, and they are found in apartments way more than you would expect. And so most insurance policies are going to have a warranty that it doesn't have those. A lot of insurance carriers ask the question up front, does it have those? And if you answer yes, you're going to have a hard time getting insurance at all. So identifying those factors before you go under contract, you put your earnest money down, and it's too late to back out, to identify those problem factors. And
Yeah.
that's what we try really hard to do, is work with our clients on the front end to identify those problems before it's too late.
Yeah. And one more that I know we've worked with you on, and that it's important to know immediately. And it's maybe seems obvious, but for a newer investor that might not be thinking of things like stop block panels and aluminum wiring. And one more, is the property in a floodplain? There's easy data to figure that out. And you would hope that the current owner, would be kind enough to disclose that to you, or that their current insurance would show that the property's in a floodplain. They'd be paying those kind of premiums for being in a floodplain. But you want to know if the property is in a floodplain, and that we have insured properties, bought properties in a floodplain. And then, Bo, you probably have seen people go and get that floodplain map challenged and have the property taken out of the floodplain by having a civil engineer come out and take a look at the property, do a site survey, and prove that the floodplain obviously is then maybe the map is not accurate, or the property is not significantly enough in the floodplain to cause a real insurance risk. Is that something that's recommended to the insured clients of yours?
Absolutely. So, we partner with a firm that goes out and they have internal data that they'll look at on the front end. And then if they think there's a possibility of potentially getting a LOMA, which is a letter of map amendment, which can move it from a AE, which is a high hazard zone, to an X zone. So under a high hazard AE zone, your lender is going to require flood insurance. There's really no way of getting your lender to not require it, especially on agency debt. And so identifying that early on by just going to FEMA.gov and searching the address, or going into the internet and looking at the local county flood map, is one way. Because when you look at insurance and you're trying to figure out a cost per unit, flood insurance can drastically drive that cost per unit number up, and you don't have a whole lot of leverage unless you do partner with one of those alternative vendors that will identify and maybe improve it. But that success rate's probably around 15%. So I'm not really willing to take that 15% gamble that it's gonna work out unless your underwriting, your pro forma has that flood built into the cost.
Yeah, you want to budget for it and look at it like a windfall. We've done it that way. We've only been successful with one or two appeals, I think, as a company, and it's never been part of the business plan. It's always been just icing, let's say, in that. So all good points. But as we kind of wrap things up here for our conversation, tell me where, again, you said we're in a hard market. Now I understand soft market. Hopefully our listeners understand that too, now that we've explained that. But tell me more where you think 2025 and beyond's going, everything from like kind of predicting, the next year or so. But also on the beyond side, where do you see, is insurance changing to a point where us as investors should be prepared for any changes coming down the pipe longer term? So yeah, but break out your crystal ball if you don't mind, and tell me short-term, long-term predictions of where you see the market going.
Yeah, I see the market kind of staying where it's at, or improving a little bit over the next 12 to 24 months. As I said, it typically kind of runs January to January. So we have a good idea of where 2025 is going to be. If we don't have a ton of hurricanes or natural disasters in 2025, I think we could continue to see improvement in the market. There was a lot of scare a couple months ago with Helene and Milton, saying that if one of those hurricanes had been as costly as what we all thought before they made a landfall, that we could be right back into 2023. So that's how thin the insurance market is right now. But if the economy improves and we don't have natural disasters over the next year, 2 years, I think we're going to see trends going down. Carriers are being more picky on age of construction. Data has shown that newer construction performs better in catastrophic events. So your newer properties are going to yield better results. Your properties that are in lower crime score areas than higher crime score areas are going to get better general liability rates. They're going to get better terms from the carrier. And the amount of data these insurance carriers have been able to build into their modeling over the past, say, 5 years or so, it has just been mind-blowing. It seems like every week they're coming out with some new model that tells me a reason why they don't want to quote. And it tells me that they have the data to identify where they're seeing profitability and where they're not seeing profitability. I don't have all of that data, and it's varies by insurance carrier, but just looking at properties, would you want to live there is a common question that I'm asked, and when I hear insurance carriers talk, is would you live there? And if not, they're probably thinking the same thing, and you're gonna not be happy with the outcome. So partnering with a great property management company, executing your capital plan, keeping that data of your capital plan of what all you've put into the property, what prior owners have put into the property, and being able to show that and reflect it and have an insurance agent that understands that and how to present these risks to the insurance companies is really important. And you're going to see drastic differences. And it's hard to find a really good insurance agent that understands the space, but we're doing everything we can to bring in younger generation to mentor them, because real estate is a great industry to be in. I'm very passionate about it, and I'm excited for the future. I think that we're going to see improvement in the coming years, as well as hopefully interest rates drop and we can go back to 2018, 2019.
Yeah, to a degree. I think the pot of boiling water was boiling a little too fast back then, but I'll take an average. I'll meet you in the middle, at maybe not white hot, but orange to red hot of a market would be just fine. So great. So for those that are looking for an insurance carrier that's willing to educate and go to bat for them, as your company is for us, how would a rising operator like us reach out to you to hear more about what your company can do for them?
Yeah, you can call me. My direct line is 770-250-5315. And my email address is bo.shaw@ioausa.com. I'm sure Matt would be happy to introduce anyone that's listening, and I'd be happy to talk to you.
info@DeRosaGroup.com if you want us to do a personal introduction to you, the listeners here, and Bo and his team at IOA. We would be happy to make that introduction for you. We're very proud to call Bo and IOA our insurance carrier for all the stuff that DeRosa Group owns and operates. Bo, thank you so much for joining me on the DeRosa Insiders Live program today. Really great conversation for something that I think is misunderstood in the real estate industry, and I hope that you helped us and our listeners here shed a little bit of light, better understanding, so they can be just that much stronger as real estate investors themselves. Thanks for being with us today.
Thank you, Matt. I appreciate it.
Cool. Guys, great conversation with Bo. A few things I want to highlight here that I want you guys to understand. You got to do your homework up front. You cannot just buy a property and cross your fingers and hope the insurance carrier gives you a good number. That's number one. You got to do some due diligence, making sure that there's not some of the snake traps that Bo had referred to, aluminum wiring, floodplains, those kinds of things that are going to jump up and bite you. People still need to live in these properties, but you want to make sure you know what you're getting your teeth into here. And in addition, when you're doing deals, it's great to have a great insurance carrier that's in your corner, willing to give you great numbers and go fight for you to make sure that you're being treated fairly by the insurance underwriting team. So we recommend IOA. You guys should check them out too. Just a quick highlight that I just wanted to touch again on the current event that I touched in the beginning, guys. The market is going to stay strong, I think, on the housing sales and need side because of demand. Because there's still a huge demand for housing in America. And I think that we're going to see that regardless of what happens today on the election or regardless of the future, we're going to see more and more need for housing. And that is going to continue to keep up housing absorption regardless of how much supply comes on. So I think it's important as real estate investors to acknowledge that and to maybe contribute to the supply that's out there by doing fix and flips, maybe some new construction stuff. That's something we're working on. Maybe you guys want to do that too. That's what we got today, guys, for the DeRosa Insiders Live program. Make sure you join us next time that we're live on all of our social feeds and check out this program on Spotify as well. Take care, guys. Thanks for listening. Thanks for watching.